Hey, what's going on, guys? John here. I'm at Stuytown, about 15 minutes from Central Park, at one of the largest lawsuits to see 2020 when courts reopen. So I'm in New York City. It's an 80-acre project, 80 acres, 11,200 units, partnership between Blackstone and Ivanhoe Cambridge. They purchased this deal for $5.3 billion with the intention of keeping rents relatively low until 2020, where their deal with the city expires, where they then can increase the rents and return a profit to their investors. So they stood behind their side of the deal, and over that 5-year period, they've spent hundreds of millions of dollars improving the building. And then it comes time to fulfill the city side of the deal, and now the city's saying, no, we passed a law in 2019 that overrides our deal in 2015. Think about really what that communicates. It communicates that the city can basically do whatever they want whenever they want, and no deal, nothing really means anything. They can simply just make up the rules as they go along. Blackstone now is stuck with this building where the average income at this apartment complex is over $100,000. It's over $100,000 per unit. So you think about that. These aren't low income. This is not low income. And what the issue really becomes here is that these buildings are based upon the income derived by the property. So if the incomes are low, the taxes are low, and the taxes are what funds the school districts, what funds the police departments, street services, all of these other really outlets that service the community. And so they want to keep the rents very low, which then in turn is going to hurt the community long term. It's going to hurt the community long term. Students, kids, everyone's going to get older, outdated textbooks. There's not going to be as police department's not going to be what it should be, and it's just getting crazy. It's getting really messy, and this lawsuit is going to forever impact the landscape of New York City real estate. So that being said, I'm going to show you the facts, the details. I want your feedback on this. Tell me what you think the right thing to do is. Is the city right to make a deal and then retract it after the deal is done? Let me know. Please like, comment, and subscribe.
Blackstone is one of the world's leading investment firms. They have offices all over the world, and they manage over $500 billion in assets under management. It is absolutely incredible what they've built and what they've achieved over such a short period of time. And they've leveraged their relationships in such a way to drive even more impact to their long-term goal and long-term focus. They create positive economic impacts and long-term value for their investors. And their investors are insurance companies, pension funds, just very, very large-scale investments that they use towards either real estate investing, towards leverage buyouts, buying out other companies, to everything in between. And they do this in such a way to protect their investor and to drive a huge profit to Blackstone. And now Ivanhoe Cambridge, they're a real estate developer and operator. They have interest in over 1,000 buildings across 4 continents with over $65 billion in total asset value. And they leverage their experience and track record with others who also have a similar track record to where they can then split the risk. So they can put up a small portion, and then Ivanhoe Cambridge can put up a small portion, and they can split the risk and split the profit. And it works out quite well for both sides, especially when a deal goes well and when it doesn't, because one wrong deal, if you're 100% owner in, it can really make a big impact to your bottom line. And this is coming true for Stuytown. They're splitting the risk here, and they're both going to be fighting for what they believe is right, which is the initial deal that was struck between them and the state of New York. The agreement was that the investment firm would keep 5,000 units below market rate for 20 years, and that 20-year period expires in 2 weeks, June of 2020, renting out the remaining units under whichever housing law applies. At the time, that meant deregulating apartments would begin this year. This article was just 2 months ago. Blackstone indicated to our elected representatives that they would follow the terms of the regulatory agreement and that means 6,200 units are slated to be deregulated, said Susan Steinberg, president of Stuyvesant Peter Cooper Village Tenant Association and plaintiff in the lawsuit. Driven by the promise of double-digit returns, the firm made to investors, Blackstone has every incentive to stick to its business plan. And the plaintiffs are targeting a legal gray area that could permanently lock other New York apartments into rent regulation if their claim holds up in court. The J51 incentive program, which provides the city landlords with a tax break for making building-wide improvements, keep those units rent stabilized for as long as the benefits are received. What happens to some of the apartments after the benefits expire is now being called into question by the Stuytown lawsuit, which could block the city negotiated agreement and have even wider impacts on New York's multifamily market. Some industry observers say hundreds of thousands of apartments covered under the J51 program could be affected, including units owned by other major New York landlords. So think about that for a second. New York City just passed the strictest, most tenant-friendly laws that New York City has ever seen ever, just last year. And now with this new lawsuit, there's over 430,000 units that come to question. The investment giant maintains it will prevail because the courts will abide by their prior settlement. And I want to agree with them. I mean, if you make a deal with someone and that deal is a mutual exchange of value from one side to the other, meaning Blackstone gave the money and the city gave the rights to future upside potential down the road, and then just before receiving Blackstone's side of the prize, they end up changing the laws, forcing now Blackstone from being an investor to them now being more of a city servant, which is ultimately what they did not sign up for. They signed up to earn a profit for their investors, and that was the side of the deal. And now they're going to be stuck with this multi-billion-dollar project under new and strict New York rent control laws, and now puts their investment at large risk, as well as all of their investors and their reputation on this new deal. So it's very interesting the direction that New York is headed and in right now with rent control. And it will be interesting to kind of see how that works out in this new world that we're living in, where the cities, everything's shut down, and tax revenue is going to be hit in a very, very large way. And if this does pass and the city does retract on their side of the deal, this is going to put much attention to the lack of freedoms investors receive operating buildings in New York. We are confident that the court will reaffirm the 2012 Roberts settlement, which explicitly stated that these J51 units should no longer be subject to rent regulation as of June 2020, a spokesperson for Blackstone said. Some argue that the tenants of the sprawling East Side complex, once a haven for the middle class, are far more well-heeled than the average rent-regulated tenant in New York City. The median household income within Stuytown is nearly $100,000, while the median income in the neighboring Peter Cooper Village is $123,563, according to the latest American Community Survey estimates from the Census Bureau. The attorney for the plaintiffs argued that the point is irrelevant. The question is, what is fair rent? Regardless of whether you're rich or poor, Collins said, the whole process of high-income deregulation only caused tenants to lose apartments so that even higher-income people could make money off the apartments. And bad timing for Blackstone. Very bad timing for Blackstone. A year before they were going to realize their profits, the New York Rent Control Board made a large change to their laws. And then on top of that, early this year, the state went into lockdown. The country went into lockdown. The world went into lockdown, losing millions upon millions upon millions of jobs. And now the world is in a state of fear. However, at the time of this deal in 2015, the skies had never been sunnier. There's never been more jobs. People were making a lot of money. Everything was great. The world was great. And no one could have predicted what 2020 would bring. However, that being said, they are trying to use Blackstone as the rich guys laughing in the room who are taking all the profits and taking from the poor while making themselves rich. However, my question then becomes is, regardless of perception, is a deal a deal? Really, is a deal a deal? Can the state retract back on their word after making the deal? And that's going to be determined. It's going to ultimately shape the way that people view New York real estate. They're going to view the city and the state differently based upon the outcome in this deal. And my other question then becomes is, what happens with now the state being on lockdown, losing a tremendous amount of money, a tremendous amount of tax revenue? How can they afford to decrease property values even further, then even taking more tax revenue from the state? And as we all know, that income from buildings translates into higher property taxes. The more money a building generates, the more they're going to contribute to the state. So that being said, it will be very interesting to see how this all plays out. And I'm curious, what do you think? Do you think that Blackstone should win or should lose? Drop it in the comments. Please smash the like button and consider subscribing. I'm going to release new videos circling business, real estate, and investing all throughout this upcoming recession. So there's a lot to learn here, and thank you so much for watching.